What's going on, guys? It's MattFractal back with another video. As you know, we get straight into the videos, but before we do that, I would like to show you guys what we did today in the Telegram channel that I want you guys to join, because eventually we are going to open up our private Discord to new and old members. So we're trying to funnel you guys in right now into the Telegram channel. It's free. You guys are going to get a news release in the morning for the New York session, just so you're aware of all the news, the red folder, orange folder news for the day. So we sent this out this morning around 7:23. Then you get a higher time frame analysis on the dollar index, and it just basically puts you in premium discount on a higher time frame. So when you go down to the lower time frames, you have a clearer understanding of where you are in the bigger picture. Then, getting closer to the news, we show like a H1 view, like the hourly chart, because if you're a day trader, you should be looking at the hourly chart. We sent that in, just updating the community on what's going on in the dollar market. And since this is the free Telegram channel, we don't share trades. Like, we don't say, hey, buy this, uh, sell this. We just show the aftermath of what we've been basically showing you guys in the morning. So today's video, we're going to go over this trade on the euro dollar that we took today. And we sent it to the free Telegram channel after the move played out. But when we open up our private Discord, these trades here that you see, the signals are going to be sent by the euro dollar here with an explanation of why we're buying the euro dollar. So with that being said, let's get into the video. So we're on the dollar index chart, and we're going to start on a monthly. We're not going to spend too much time on the higher time frames because I will save that information for my course and for my private members. But of course, I started here on a YouTube channel, so I'm never going to neglect the YouTube community. So we have this fair value gap here. That's pretty obvious. If you trade smart money, you've been noticing this fair value gap. So we can draw it out here. My premium levels, I use red. So this is a premium from this high to this low. If I grab Fibonacci, right, above the 50%, meaning it's a premium. Okay. So the dollar index, we traded up into a premium, fair value gap, and we're trading into it now. However, with this price action here being so close to this old high, and as well as the dollar being bullish around the summer months, I'm actually looking for a rally to fill in the gap between this candle's low and this candle's high. So with that being said, I also see on the discount side this inversion fair value gap that I've been watching, and I sent out to the free Telegram channel. So let's use a blue box, blue rectangle. This candle's high is the low end of this inversion fair value gap, and May candle is trading into it now. We're seeing a little bit of pullback. So we would have to see when this candle closes, and then June when we start trading either lower or higher. So that's all I had on the higher time frame on the monthly. This inversion fair value gap, and then this clear bearish fair value gap. So going down to a weekly chart, which is now starting to be my main time frame as a short-term trader slash day trader. And the reason is because Most of my trades are going to be inside of one full week. And if I'm in this weekly candle, I know I can profit if I can find either the weekly high or the weekly low, right? So today, well, today's the 30th, but this week we traded above last week's high into this last up close candle, right? Yes, last week we traded into that opening price, as you can see, and then it gave a little give back. That could have been a trade last week, looking for a price to trade up into this order block, which it did. And then you can go on a daily time frame, 4-hour time frame, 1-hour time frame, and try to catch a move going back, since this was the weekly high. Now this week we had the same kind of concept with this candle trading up above last week's high, but not just into this order block's opening price, because we used that price point last week. If you grab the 50% of it and we start putting in our quadrants, we have opening price, we have closing price, but in between that we have the quadrants. We have the 50%, that 25, and then 75. So 0.25, 0.50, and 0.75 is our quadrants. So as you can see, we traded up above last week's high, but we traded into that 0.25 lower end quadrant of this bearish order block. Not a lot of people teach that. ICT, he teaches that, but you would have to really know his content. So we traded up into that, and let me get that back on there. I'll use this as a level, a daily, a weekly level that we were looking to play off of. Right. So now if I drop down into a daily chart, you're gonna see how perfectly it lines up. Right. So we have this old high back here, traded down, and then we made an old low. Right. So this, to me, is a range from this high to this low. So I can grab this. I'll get rid of the quadrant. So from this high to this low, as we're trading back up, right, on the daily chart, what are we trading into? Now that we're on the daily and we're looking at it from a daily standpoint, we are trading back up into a premium price. So we delete this. Today, specifically today, when price traded up into that weekly level, as well as traded above these old daily swing highs, as well as if you refine that weekly level, it becomes a daily inversion volume imbalance, which nobody usually talks about. This volume imbalance, sorry, when we traded away from it and we came back down, as you can see, we had some type of reaction, but we flew through it. So when we traded back up, we used this as an inversion level. So I can refine it here. Boom. So we're looking at this main candle right here, right? The May 7th candle, Tuesday. So looking at today's price action, we traded up above yesterday's high into that weekly level, which refines into this inversion volume imbalance, which is basically just this order block. If you use this as the order block in this consolidation, because this candle is smaller, this candle is smaller, and this candle is smaller. This is like where institutions bought the most, so the algorithm is definitely going to refer to this price point, which it did. So now dropping down into a 1 hour, now we're getting a little bit more detail. Right. Price was trading up into that daily premium, Wednesday, we trade up into that inversion volume imbalance. So if we're trading up into a daily level here, and we start to see price trade lower, where do we expect price to go? Because that's what we need to know. If we know where price is going, we can get into a move to finally reach that terminus or that end price of where you think price is going. So let me get deeper into the price action. When price is up here and I'm looking back down into this range from this high to this low, I'm either going to be looking for two things. The first thing is a gap in the market, so a fair value gap. Make this blue. So when price trades up here, you have to look down into the range. We see a fair value gap, right? So either the high end or the low end could have been some targets that you're trying to reach for. So price is up here. This is a clear point where price should reverse. Now we're looking down into the range on a smaller time frame to see where price can fill in or attack. So the first level is this fair value gap here. That's the first attack. Second one would be here. And as you see, price fulfilled these levels. First fair value gap, second fair value gap, and the second criteria or PD array that I look for is old lows. And this is for when we're trading on the bearish end. So we're up here, we're gonna expect to go bearish. So I need to find old lows to go attack the sell side liquidity. If it was opposite and we were trading higher, we would be looking for the same fair value gaps, but we would be looking for old highs, because that's where the buy side liquidity is at. So when you're selling price, when you're looking to be a seller, you're looking to target fair value or sell side liquidity. So we have fair value here, fair value here, we have liquidity here, which we're currently trading here now. The London close is going to be over in the next 15 minutes, so we are just going over what we did in the New York session today. So these will be all your levels: the gap here, and then the old low. I'll take all of these other lines off for the fair value gaps just because of the reference. We already see it, and now we're here at this old low, right? So now when price is trading lower, either into this fair value gap, or this old low, our goal as a trader, or my goal as a trader, as an intraday trader, is to basically find a retracement inside of the New York session to get me from point A to point B. Point B, we need to know that first, because without knowing where we're going, point A is going to be hard to find, and I'm going to explain what that means. But I want to go over point B. Point B is our terminus. We know that we're coming down to this fair value gap, or this one, or this old low. I like to look at the old lows because we're looking at this range from this low to this high. So if we're bearish, price, is most likely going to run out this old low. And if not, we would stop at a deeper discounted price, not this fair value gap, which looks like it's above that equilibrium price point from this low to this high, even from this low to this high. So if you're selling, look to get your profit in a discount or below the old low. Now going down to a 15-minute time frame, this is now where we get where we can get our point A concept. So if I grab a vertical line and I plot it on the New York Open, which is 7 a.m. Eastern time. So anytime I'm trading, guys, I'm using New York time. So make sure you guys remember that. So I'll plot a line on 7 a.m. New York time. And as you can see, now my market is kind of built out for me. It makes it more easier because I see this line here, and I know, let me just mark it out, that this is the daily inversion volume imbalance, right? Make this a little bold. Yeah. So we have a daily inversion volume imbalance and it's bearish, right? Then we looked inside of the range, we seen fair value gaps, but mainly we're looking for that old low. So now from this inversion volume imbalance all the way down to this old low, we have about 48 pips, roughly 50 pips, all right? So if I'm a day trader or even a scalper, 50 pips is a respectable move, right? But look where we open for the New York session. We opened around that equilibrium price point from this high to this low. So we know we're not going to get the full 50 pips. We're going to get like maybe 25, 20 pips. So this is also understanding the narrative. If we're here, if we open up here for the New York session and our trades come in the New York session, we know we're not going to be able to necessarily hold for the 50 pips from this high to this low because we open up in the middle of the range. So knowing how far your trade will go can also help you as a trader. Because instead of having the expectation that if you catch a trade here, you can go for 50 pips, it would be better off saying, okay, we open up closer to the equilibrium price point. I know I might not catch the full 50 pips getting back to this old low. Obviously not. So we will look for maybe 15, maybe 20 pips. But that all boils down to what type of trader you are, what kind of risk appetite you have, and how well you know your market. So wrapping this up, dollar index, we had a nice little high to low. We broke the structure here, right? High to low. I'll grab a Fibonacci. This does not look like it hit a deep discount, but as you can see, we traded above that 50%, meaning that when we traded here, the algorithm classified this market as I'm wondering if any of you guys said it before I said it. They classified this as a overbought market, right? It's overbought because it was in the premium above the 50%. So if it's overbought, smart money likes to sell overbought markets. So smart money sold here, and we continue to trade lower, straight to that one extension. We consolidate it, and then we continue to go lower to clear out sell stops, making this a ICT sell model. And we're selling it inside of that second stage distribution, right? Let's go down to a 5-minute, make it look way clearer. We traded up into that daily inversion. We had an old low here, and you look to capitalize inside of a time element, which was the New York session. You wait for a retracement, a decent size retracement, and that retracement should be the next leg to terminus, which is point B. So this would be point A, point B, but point B is more important at times when you know it, like when you need to know where the drawn liquidity is. So the old low, sell stops, drawn liquidity. Point A was the entry. Take point A to point B, and that's done. So I'm hoping you guys learned something from this, and join our Telegram group. You guys will be able to see how I navigate these markets day in, day out. And when we do open up our premium Discord, I will let you guys know. MattFractal out.